You're tuned into Agriculture Today, and we start our Friday show with a grain market update from K-State grain economist Daniel O'Brien. Daniel, thanks for joining us today.
Thank you, Shelby.
Daniel, for the grain market, currently seeing some low grain prices, and why is that?
Well, we have every presumption in the market that we'll have large crops. And even though usage has been pretty good in a number of sectors, particularly for corn for exports, ethanol not bad, uh, some other factors, not wheat until just recently doing pretty good export wise. Soybeans, a fairly decent crush. Even with all that, the narrative of the market is at this time is to pay attention to crop size and still expecting large crops well, again, for corn, for soybeans, we've already had a large crop for wheat, and we really don't see any factors changing that. There's been some uncertainty and questions also about what impact tariff discussions that the U.S. has had with various countries, what that will have on trade, and still the big uncertain figure out there, particularly for soybean market, has to do with how U.S. and China uh, uh, tariff discussions will work out. Again, with the idea that China might come back in pretty strong on the soybean market and or the grain sorghum market. We'll see. Anyway, either way, you got a combination of production factors and geopolitical factors in play that that are being responded to in a very, I guess, if you're talking about the size of crops, a very positive way. If you're looking at the outcome of large supplies and growing supply demand balances, you're looking at factors that would put a damper on prices going down the road. There are other factors to consider. Again, it's now August 1st, and we can talk about the significance of that going forward if you'd like.
And you mentioned that we're expecting large crops. When you say that, are you meaning for just Kansas or for other states as well?
Really, for all states in the United States, when you look at drought monitor maps, and when we hear from Chip Redmond and others here in our shop here at K-State, but I don't see a lot of concern around the nation. In fact, almost all places show quite a bit of moisture, except depending on which map you're looking at, some of the parts of Illinois, Indiana, and uh, and up into Michigan, a little bit of Ohio showing some long-term dryness. I hear along with Chip other respected climatologists talking about pockets of dryness in some very important corn and soybean growing areas. But overall, the presumption of the market is that we're sitting here on August 1st. We haven't had a drought overall, so we're presuming it to the high side at this moment.
Is there a scenario where producers can still have a good crop and high prices?
Yes, that would be uh, very much dependent on strong usage. The you've got a combination of factors, these supply demand balance sheets. If you come into a marketing year, again, the one that you finished up in the past, you've got really low beginning stocks, and anticipate often other countries, either due to geopolitical reasons or droughts in South America or other major crop production regions, that you'll have strong usage, strong exports, strong domestic usage. Uh, then you could see a situation where we have sizable crops, again, 15 billion bushel plus corn, 4.2, 4.3 billion or 4 billion bushel soybeans in the US, but then have ending stocks for corn, say around 1.5 billion bushels or less, for soybeans, something like 250 million bushels or less. Those, or for wheat, again, similar situation, although we haven't had it for a bit in wheat, where you'd be looking at something closer to 500 million bushels or less. Then yes, you could see even with large supplies, you could have tightening stocks because of really good usage and end up with decent prices. But that's not what we're looking at right now in 2025, heading into 26.
As we're talking about these low prices, anything notable when we look at the futures or cash?
On the cash market side, it's interesting. Again, you and I watch this on a weekly basis, and the emergence of Southeast Kansas in the last week as having really, really strong prices. And you look at when we look at listings of cash, when I look at cash grain bids, we try to report the highest price, and often you'll get a terminal or something near an ethanol plant or a soybean crush plant, not the plant itself, but for elevators nearby, you'll see a really high price, and that price might be 20, 30 cents higher than other elevators around it. And in that mode, you're having an in and out charge coming from the other elevators to these major terminals. That said, I look at Southeast Kansas. The corn price for yesterday's closes, $4.09 top price, and then for harvest $4.18. That 409 compares to 404 in Garden City, and normally Garden City is all pretty much been our standard bearer for high cash corn prices. The new crop bid in the Garden City area is still higher, 424 versus that 418. But when you look across the rest of the state, the highest prices that are available everywhere else in the Northwest Kansas, North Central, Northeast, South Central, they're all well below $4. So you have these two areas really providing pretty strong price leadership for corn, and the others really reflecting the anticipation of large harvests coming on, even though it's only August 1st. And you do see a similar situation again, Southeast Kansas, gracious. The grain sorghum, strongest grain sorghum bid is $3.97 and as a cash price, and for sorghum here in Kansas, there's nothing else above, well, 359, a lot of them closer to just say 309, 310. So you have that situation again, a strong head turning bid for sorghum bids at say $4.17 for again in that southeast area around Pittsburgh, Kansas, and really no other forward bid above 374. So southeast Kansas really standing out. You do see more. I guess not quite as much disparity for soybeans, but again, Southeast Kansas bid for beans, and they have a new soybean crush plant down there, $9.99. Nothing else above 974. So they get that, and that being in Topeka, which arguably is probably influenced by Southeast Kansas, but then for wheat, the strongest cash bid, South Central Kansas near Hutchinson, about 525. And then Pittsburgh also coming in again, one strong bid, 531. So you got that Southeast, South Central Kansas activity going on, and other prices. In Western Kansas, closer to 450, 460. And so you've got some price differentials. When we talk about these price differences, that's what people that have grain trucks pay attention to. If they happen to be close enough to those areas, they can arbitrage those differences, but they have to pay the transportation cost to get it there to force these markets together. And at this time, especially with wheat, we have quantities of wheat around the countryside. You've got forces that are kind of holding the wheat market down. If you would like to, I could talk really quickly about what. Well, I know we have lower price situations right now, but if we have time, I'd like to speak a little bit about what the probabilities are for an alternative outcome. And just okay, so for corn, you look at the current situation, what the USDA just projected in July, probably a coin flip, about 50% chance they're right, but still that you've got a pretty high yield there, and there's probably about a 45% chance of something a little bit less, 1 or 2 bushels lower at about 179 bushels an acre. And that would you run that through the supply demand balance sheet, that'd make about a 40-cent difference on the price if we got something like that. Instead of 420, the USDA is projecting about 460. And you look for soybeans, again, the USDA is projected in this July report about 52.5 bushels an acre. If that's 51 bushels an acre, and still it's only August, it's only just the beginning of August, that could come into play. And instead of but if you go from 52 and a half to 51, still a very good U.S. yield. You're looking at something like instead of 310 million bushels down to 244, 245, and a price working its way through about instead of $10.10 like the USDA, 10 cents a bushel like the USDA has projected, yeah, you're looking at $1 or more gain from just that much of a change. So really, soybeans are more on the edge in terms of supply demand balances than really corn is, and we're coming into the time frame when that's at issue. I'll just say real quickly, the USDA, when they report in their August 12th report, they'll be looking at what farmers tell them via electronic, mail, phone call surveys, what they think they have in the field today, August 1st. And generally, we don't hear a lot of pessimism on farmers' part. Would not be surprised that number comes in pretty strong. We really won't have the USDA out into the fields or get that or being a month closer to the harvest till we get to the September survey. So I don't know that I'd be real optimistic in the short term that we'll have any solid data from the USDA that has the potential to support prices more or support markets. But we'll see where things go. A lot's going to depend on weather and how trade, usage, and other factors all work out in the grain markets.
How accurate usually are those reports?
Well, the average trade error of forecast for the July numbers is about for corn, it's about half a billion, well, 500 million bushels or so. And the biggest error they've ever had, they missed by 2 billion bushels. Of course, I think that was a late set of crop issues at tough weather in July. For soybeans, 136 million bushels is their average miss, and the largest they've ever had as a miss off the July numbers that we have is about 430 million. And as you go into July and August, not that much different. On average, we miss by about half a billion bushels for corn and about 135, 150 for soybeans. But we'll see where it goes.
Daniel, I appreciate you taking the time to join us today.
Thank you, Shelby. I appreciate it.
That was K-State grain economist Daniel O'Brien. We're cutting to a short break now on Agriculture Today, but we'll be right back.